Key Performance Indicators, the numbers behind the numbers, brought to you by CFO On Demand from Patrick, Bongiovanni, and Kelly, CPAs. Please support our sponsors, McPeak Wealth Management Group of Wells Fargo, Ansero IT, Levin Stoller, Attorneys at Law, Allegra Marketing, Integris Investing, Tim Pashley, Cooper Levinson, Attorneys at Law, Rich Asset Management, Ocean First Bank, Sturdy Savings Bank, Bank of America, Persky Marone, Attorneys at Law, Merrill Lynch, Altor Oakley Group.
Morning. My name is Brian Jolakowski, and I'm a member of the business banking team at Bank of America Merrill Lynch. As a strategic partner with our clients, KPIs are an essential for every business. We want to share with you a resource we have available as entrepreneurs benchmark their business. The Peer Profiler compares your business to an industry peer group. The data is drawn from the bank's 50,000 plus clients. This analysis can provide business owners some fresh insights to help improve performance. To give you a glimpse of how this works, we've prepared a sensitivity analysis of a company's working capital position. If you were to shift your trading accounts from current levels to your peer group average, you could free up $699,000 in cash. Assuming a 5% borrowing rate, this would add $35,000 to your bottom line. The Peer Profiler has a wide range of uses and is just one example of how Bank of America Merrill Lynch works with our clients to help them optimize performance. We are proud to be a sponsor of the CFO On Demand web series and would welcome the opportunity to conduct an analysis of your business.
And now our presenter, Lou Bongiovanni.
Hello and welcome. This is Lou Bongiovanni, and thanks for joining us at our live webinar on the topic of key performance indicators. This is one of my favorite topics, so I'm excited to give the presentation. Before we get started, a couple of housekeeping matters. You will be able to submit questions if you like. I know we cover a lot of material in a short window of time. But if you want to submit questions, you'll be able to do that. There is an icon on your screen, a hand, I believe it is, that allows you to submit questions. You can send them to me. I'm the only one who will see them, and I'll make sure to address all of them at the end of the presentation. If you have any trouble hearing me, you can dial in on your phone, and it will be clearer if you're listening through it on your computer. Otherwise, let's get started. The webinar objective today is a couple of things we're going to address. So we're going to talk about key performance indicators, or you'll hear me use the term KPI, standing for key performance indicators. We'll talk about why they're important indicators, how you can use them to get an edge over your competitors, how key performance indicators can help you with your employees in getting the most out of them. And finally, 7 ways to develop the best key performance indicators for your company. There'll be some takeaways there that hopefully you'll be able to grab from this presentation. Let's define key performance indicators first. These, many times this term is used, sometimes misunderstood. These are proven critical measurements or metrics relating to your industry or your company. And many times you'll see these in the form of ratios or percentages and things of that nature, kind of broken down the terminology a little bit here. Key in that it's key because it's to the success of the organization. It's really critical to the success of the organization. Performance is clearly measured and influenced by employees. It's something tangible here that you can see. And then these are indicators. They'll not only explain the past, but more importantly, they'll predict the future. So let's move on. Okay, 3 reasons why key performance indicators are so critical to a successful business. Number 1 is it's a great communication tool. It allows ownership or management to communicate their expectations to the other employees of the organization. Many times it's difficult. Owners are busy, managers are busy. It's difficult for them to find a common language to speak to their subordinates in a quick and precise way. KPI help guide that kind of discussion. It's also a predictor of the future if used properly. We'll go over that in a few slides, but that is the real magic to these key performance indicators if used properly. And thirdly, they're an objective measurement tool. It strips away a lot of the subjectivity when we're looking to measure a particular initiative or person. These measurement tools strip away those things so that you could focus objectively on how a particular person or initiative is doing. There are 2 broad types of key performance indicators. The first type are lagging indicators, and these are the ones that are most common. They tell you what happened with a company. They look at the results of what a company has done over the past month or quarter or year, and they try to give more insights. And that's where I got the title, The Numbers Behind. The numbers is that you look at the common financial statements, and then there's some analytics done to it to explain what happened in a deeper way. Some common key performance indicators that are laggers are gross profit, net income, EBITDA, which is earnings before interest, taxes, depreciation, and amortization. There are these type of percentages or ratios that help explain where a company has been. The other type is leading indicators. These are especially powerful, and they look mostly at the future of where the company is going to be. So these are activities tracked as opportunities are developed. So these are future predictors. These are mostly used to drive revenue, which is the key to a company's growth and success, is to drive revenue. So these type of indicators look like this. There are maybe how many calls a salesperson did per week, or what's a salesperson's or sales department's success ratio, how many calls do they need to make before they get a successful sale. These are futuristic ratios so that if you're looking to grow or drive the company and you know past performance of the company, you can use that to develop leading indicators. So you use leading indicators first, and then you can use the lagging indicators to see how well or how poorly a company performed compared to your expectations. So leading indicators not nearly used as much as it should be, mostly for the sales department. All right, let's look at key performance indicators in 4 broad categories. I broke it down into sales, profitability, cash flow, and borrowing. These are 4 common areas where you see a plethora of key performance indicators. In the sales category, usually what you'll see is an indicator such as sales per day or per month or quarter or year. That's a pretty obvious one. You'll look at average sales. So you'll say, okay, what's a transaction? What's an average sales per transaction? You'll also look at the number of transactions. So there's a lot of indicators directed at sales because it's such a driving force to the business. And those ones most people have seen. The second type or category of key performance indicators is profitability. This is where you're looking at the net income. Sometimes they look at gross profit, which is sales less cost of goods sold. EBITDA, I had mentioned before, is pretty common with profitability. Many of the banks or finance companies or companies looking to acquire another company will use that term EBITDA. You've heard me use it when we did the webinar on valuations. That is a pretty common standard as to valuing a business. So profitability, obviously sales is important, but profitability probably more important because it's not necessarily what you bring in, it's what you get to keep. So this is a way of measuring how well a company is doing as far as maintaining the profits. Third category is cash flow or liquidity. Many banks use these last two actually, but this third one is cash flow. This shows how a company is managing the cash in their business. Are they able to pay their bills on time? Are they able to collect the revenues they've earned on a timely basis, or are there some issues there? So key performance indicators, frankly, for all these categories, don't only tell you how things are going as far as your company, how things are going well, they also give you an idea when things maybe are not going well and gives you a heads up so that you can address it more proactively and not wait until it's too late. Another indicator under cash flow is days in accounts receivable, days in accounts payable. They call days in AR or days in AP. They're also very critical as far as how a business is run. And lastly, borrowing, a big indicator, usually with lenders, is you look at things such as debt coverage ratio. This tells a lender or gives a lender the comfort as to how well the borrower can repay the amount that they're looking to borrow. They might, a borrower might be asking for funds and their cash flow won't support them being able to borrow as much as they're asking for, so a lender would pull back and lend a lesser amount. Key performance indicators are very critical to making that judgment because they can't just look at the plain financial statements and then feel comfortable to lending. They need to look at certain ratios and indicators such as these. We've talked about key performance indicators being very helpful in giving a company a competitive edge. And I've seen this in many instances where companies armed with key performance indicators, giving them a better knowledge of themselves, allows them to analyze their competition that much better. So the first bullet here, it helps predict future sales performance. So what I alluded to before, the whole leading indicator, where if you know your company has a certain success ratio, as far as calls versus or touches with a client versus success, and you want to drive revenue to a certain level, you know, we use this term, it's a numbers game. The more at-bats you have, for example, the more opportunities you have to get a hit. So as a result of that, that is a good predictor of how well or how quickly you can drive sales, is knowing what your success ratio is and what you need to do to perform to improve it. Second bullet point is tracking your competitors. In this day and age where there's so much information available online, even to the smallest companies, they're relating to their online presence, their website, and how much information they offer there. It is easier and easier than it's ever been, if you're looking at the right things, to determine how well your competitor is doing in certain areas. So for example, if you look at their online marketing activities or the pricings that they offer through their websites or different promotions, or if you get on the competitor's mailing list, if someone get on a competitor's mailing list and you see what activities go on and you apply certain key performance ratios, key performance indicators to that, you'll be able to get a feel for what they're going after and what their plan is and how to position yourselves accordingly. And that applies to large competitors as well as small ones. You can use these tools very well, but they're very precise and when used properly can give you some really great insights as far as how your competitors are behaving. Two other competitive edge items is developing competitive performance-based incentives. We talked about that in the last webinar, developing incentives for key employees. Unemployment's been the lowest in over 40 years, so we know a lot of the good employees are taken. And if you have employees that you really want, that you value and really want to hold on to, you want to make sure that you have a good competitive incentive program available for them. And if your competitor does not, because they're not listening to webinars like this and not developing them, you might have an opportunity to pick up one of their key employees because you're incentivizing them properly. You're looking at what they really bring to the company as far as value, and you're paying them accordingly. So that is a way that you can get an edge over one of your competitors who are not really precisely looking at the compensation plans. Position your company for merger and acquisition. I see that often as well. Many of companies I deal with, their growth plan includes mergers and acquisitions. And as a result of that, they need to feel comfortable that they're acquiring a company or maybe being merged into a larger company at the right numbers, and that this company is financially able to handle either my client merging into them or being acquired. Key performance indicators also give some terrific insights into that, because if you start applying a number of key performance indicators to their historical numbers and you start seeing conflicts or things that do not seem in sync, that gives you an indicator to dig deeper and look into it more, because there might be something there. Maybe there's some stretching of some information. There's some loose numbers that need to be tightened up. So key performance indicators just keeps everybody fair. Now let's talk about key performance indicators with employees. We just talked about how it can help you against competitors, but I want to drill down more with employees, because to me, this is such a great tool to use for your employees, and I believe so underutilized. So underutilized. So one point is to communicate expectations. Employees are not mind readers. Maybe they've been with you many years, maybe they're family members, but the truth of the matter is owners are constantly looking to improve their company. They're usually changing things and trying new things out. If there's not communication between ownership or management and these employees, there can be a disconnect. Key performance indicators help that communication channel and do it very well. It quantifies management's expectations. I love when an owner, we sit down, we do budgets and things of that nature to really help define what they expect for the upcoming year. That's a hard enough challenge for many owners, but at least they do an exercise such as that. And I said, will you be happy if you get these numbers? And they said, yeah, we'll be thrilled. I said, well, then let's break it down a way that we can get everybody on board so they know when you've accomplished this over a month, a quarter, or over a year, that we could celebrate. I mean, employers often just feel like they have to continuously have the whip on the employees, so to speak, here. But there has to be times when everyone celebrates and say, you know what, let's give some high fives here. We hit our goals, and we need to just kind of catch our breath and appreciate what we've accomplished here. This is a way to do it in a quantifiable manner. The second bullet point on that is provides a context to interact with employees. There's too many times when ownership and management avoid interaction with their employees because much of the conversation will tend to be subjective as opposed to objective. So if something good happened the day before, the employee is terrific here. If something didn't happen, the employee is completely incompetent. And there tends to be those kind of sweeping discussions there. And those discussions get old after a while. The employee doesn't want to hear it, and the employer needs to kind of get there. It's emotional roller coaster for them. If you use things such as KPI, where everyone knows what the expectations is, it guides it to, number one, a much shorter discussion, and it's much more pointed as results oriented as opposed to a subjective feeling, and it tends to move better. And then that next tier, because they, let's say, have to have similar discussions with their subordinates, let's say an owner talking to management, it helps the flow, and now we're all talking a common language. Next bullet point, evaluation tool. This is a great way, KPI are a great way to have clear management expectations as far as benchmarks for each employee. So when you establish a budget for the company, you should do it by department and by employee, and KPI are usually a good tool to incorporate it. And it also enables progress to be monitored just to see along the way. So you're having one meeting a year and saying, oh, you did well or you did poorly. Other 2 points as it relates to employees, a guide for mentoring or coaching. The employees who you think are rock stars and really are going to lead the company here, they need to be constantly mentored and coached. KPI is a great way of incorporating that into annual performance appraisals, which then get monitored during the course of the year. And one way of monitoring them during the course of the year is incorporating these KPIs as it relates to the individual employee. So if the employee is a manager of a store and you're expecting certain sales in that store, you're looking at that on a weekly or monthly basis, and you're giving immediate feedback with that. If something's off track with it, it gives you an opportunity to all talk about why and how to fix it along the way, as opposed to pointing fingers and blame. So it's a great tool to help mentor and coach a person, but it's also a great tool to help monitor and measure change. With all growth I've seen, change is involved. So growth is commonly driven by change. And how do you measure each person's contribution to this change is usually done by using these key performance indicators, because with change, employees tend to get a little skittish as far as what their position is with the company, because maybe their roles change. The KPI keep them on track so they can feel comfortable that as long as they're on track with it, they should feel comfortable and secure with their position and that they're going in the right direction. So now let's talk about 7 ways you can develop the best KPI for your company. All right, number 1, align KPI with division and company goals. When we talked about this in the context of budgeting and such, this is right on point. When you're looking at a company's goals for, let's say, annually, you'll establish a budget. You then can develop key performance indicators based on that budget so they support your budget numbers, and then those can be passed on to an employee or all your employees so that they know pieces of it. You don't have to worry about confidentiality here because you're just giving them the little pieces that's involving them and they can impact. And this help, and the KPI should be done so it meets or exceeds the company's goals. So people can feel good about hitting them and knowing that they're all in alignment with the company's expectations. Okay, number 2, develop KPI dashboard for each company level. I'm going to spend a minute or 2 on this screen because there's a lot going on here. All right. So number 1, you want to customize KPI so that the employees who are involved can see only what they can influence, right? So if I'm a salesperson and I'm looking to drive sales, you don't need to give me KPI that relates to efficiencies or frankly, necessarily profitability. If I have certain sales parameters at certain pricing, then really my focus needs to be driving that top line. However, for example, if I'm a store manager and the profitability of that company, not only the revenue, but the costs are under my supervision, then I need to see KPI that relates to costs. Maybe it's employee costs, so I can determine if my labor costs are too high, or product or material costs, as well as some of the general and administrative costs. So my KPI is going to look completely different if I'm the manager as opposed to the sales, the head of the sales team. Obviously, the owner will see all the KPI and then drill into that as well. So second bullet point, each level includes the KPI for levels below it. So if I'm the manager and then I have particular shift managers or department managers, we would share certain KPI with those individuals as it relates to their department. So we're all kind of looking over the same sheet or the same common metrics to determine success. And this is proven over time. So the ideal number of KPI, and these are just guidelines here. If you're non-management, if you're a person on the front lines there, so you're a teller or you're a person at the counter or you're a person who answers the phone, you want to be very specific and have just a few, maybe 3 or so key performance indicators. So if I'm at the register and I'm at a retail store and I know the average number of the average sales is $21, and I'm seeing that my sales numbers when people come in are much lower, I'm thinking I might not be doing all I need to do to support the sales of that company of what is common. So you might stop and think, what am I doing wrong here? If I'm management, which is the person's supervisor here, you would look at less specific. You would have maybe 5 key performance indicators that you're looking at on a regular basis. There would be the 3 that the non-manager has, another 5 on top of that. And the owner, looking at it again with a broader perspective, 10 is more than enough KPI to look at. For an owner, it's usually less than that, but I'll throw in 10 or so, and you're looking at the KPI of the departments below you as well. These are general rules of thumb so that you don't get overwhelmed with KPI. Number 3, in order to have the best KPI, is combine financial and non-financial indicators. The most effective KPI that I've seen is where you're not just comparing one number against another number. So gross profit is your profit over sales, and that's a percentage. That's fine, pretty easily seen. But when you incorporate non-financial numbers such as seat turnover. So if you're in a restaurant, you want to see how many tables you could turn in a particular night. That compared to sales becomes more specific to your company and more powerful. Or the number of transactions if you're a retailer and you want to know how many transactions are happening, or if you're a restaurant, how many transactions are happening on a given month or quarter, and you monitor that frequency as it relates to, let's say, a competitor opens in the area or a competitor closes in the area, and see how that moves. Or you change your pricing, see how that reacts. Many of these indicators that are not financial are coming from your point of sale systems there, or your register systems. You're marrying those with your accounting systems, because these are 2 different systems usually. 99% of the time for small businesses, they're 2 different systems. And what the KPI does is it marries a lot of that point of sale register information with your normal accounting, whether it's QuickBooks or whatever accounting system you're using, and you're marrying those 2 and creating these KPI that you usually do in Excel or something like that. And that's what brings it to life and brings your knowledge of the numbers to that next level. Number 4 is use industry-specific KPI. Okay, so you have key performance indicators that are common amongst all companies. We all want to know what your net income is and your EBITDA is, and maybe revenue by employee. But then as you drill down to your specific industry, there's going to be specific KPI that makes sense for you and that you want to look at. You want to update that annually, and you would look at a number of different resources. One, trade organizations is a great resource, and most likely you're involved in some kind of, whether it's the New Jersey Restaurant Association or contractors organization, or landscaping, it doesn't really matter. All of you have organizations that you belong to. There's a lot of information there, and you can gather from it. The internet, if you just Google things, it's amazing the amount of information you find. And then lastly, I should have added this bullet point because Brian did a nice job explaining that the banks have a tremendous amount of resources that they use because they have to use that to analyze whether someone is credit worthy to receive financing. So they do a lot in their process of determining whether or not to provide financing. So the banks, I would add another bullet point, are a great resource that you could tap into, that they're more than happy to share some of their KPI. Number 5 is more of a warning here. Not to get too overboard with KPI. Key performance indicators are a guide. They're intended to be a guide, not the end all for a company. So you don't want to use too many of them. I kind of gave some guidelines there. You don't want to get too overboard with these number of indicators. And remembering, if you're using these indicators and you're comparing it to the industry and top performing companies, that's great. But I also think you should also use these key performance indicators compared to these key performance indicators compared to the history of your company. See how your company has done over the years, and also compare these key performance indicators to the overall industry wide. So it gives you a better perspective that way, because each company is somewhat unique. So it's hard to compare it to an industry blindly without looking at it compared to yourselves. The second bullet point is, don't rely on it solely to make decisions. The KPI is a tool. It's a very good tool, but it's a tool that you need to master and understand what it's telling you. And at first, that might not be clear. So you want to make sure that analysis you might see in the KPI is consistent with other things that you're observing, whether it's a financial analysis or from an operations standpoint. You want to make sure that they're all in line, or at least closely in line, before you make a decision to promote a person or hire a new person or open up another location or acquire another company. All those are big decisions that if you just look at the pure financials and what your gut feeling is, or maybe what your couple of top customers suggested, that alone won't do it. The key performance indicators just brings another layer of an analytics and comfort to a company. We use this tool quite a bit with our employees. We use them with our clients. We use them exclusively with our clients as a very good tool to complement the financials that we use to help them understand their business better. And last point is, you want to apply this fairly to gain accurate company picture. Now, I've seen this done, and I just want to throw this out there as well as kind of the disclaimer with using KPI. Sometimes KPIs can be used by ownership or management to draw a conclusion that the owner already has in their head. So for example, if they dislike a salesperson, or if they dislike a manager, and they want to find ways to get that manager either to leave or to do whatever the case may be, they may use the KPI kind of as a stick or a sword in order to draw a conclusion that might not be accurate. So you want to make sure that the KPI is measuring the right things as it relates to your employees or to your activity, so that you are using it as a proper tool. Number 6, using leading and lagging indicators. As I mentioned before, these are the two broad types of indicators, and most of us use lagging indicators much more than leading indicators. And frankly, I see a lot of companies using only lagging indicators, which just gives them better insights as far as what just happened with our company. And they, as I mentioned, are very powerful tools. if you could start incorporating leading indicators more and more, and there doesn't have to be a lot of them. I'm not talking about volume when I'm talking about using a lot, using more of these things. You might want to incorporate one or two leading indicators where you've had none in the past and start looking at how that can impact and drive revenue. That'd be very helpful. If you start having conversations, if you're selling banquets or weddings, or if you're selling, units like pieces of equipment, you can start having those conversations and measuring things differently, or additional things such as how many calls, how many at bats you're having, or if you're selling memberships. All of those can be very helpful as leading indicators to start driving more top line performance. That's a great way to motivate the sales force, because it's difficult to motivate the sales force. It's a psychological thing where they have to get up for selling often. And if you have indicators like that where you break it down, it'll help drive that number. Okay. And number 7, the last one, is use it as a communication tool. As I mentioned, this is probably the most underutilized benefit of KPI, is as a communication tool, right? Where owners communicate their expectations in a quantifiable way, where you can specifically measure whether or not a company is doing well, or a department is doing well, by having specific quantifiable expectations. You want to display the KPI prominently, meaning that you want to make sure that it's available to the individuals who are expected to use it. You want to make sure that they can get it and see it anytime they want, so that they can use it to improve their performance. And last point on this is you want to meet periodically to discuss the KPI. So for example, you want to have in advance, whether it's, some people have daily meetings, weekly, monthly, quarterly, it really doesn't matter the frequency. You would pick the frequency that matters most. And then you would apply the KPI as it relates to those meetings. So you're not looking at the same KPI with the same frequency. So if you're looking at accounts receivable, days in accounts receivable, you might look at that monthly or quarterly. You're not going to look at that weekly, for example, but you might look at the number of transactions on a weekly basis, because you want to measure it or compare it to the same week a year ago, or 2 or 3 years ago. And that's the beauty of KPI also, is you can go back, if you're measuring especially against your own company, you can go back as far as you like, as far as you have the information, to really get a feel for these trends, and maybe some external things that may have happened, or internal, that have impacted them in one way or another. Again, using all that information can help drive how well you're going to predict the future of the company. Okay, and now a brief recap. The 7 ways to develop the best KPI for your company. So number 1, you want to align the KPI with your company and division goals. Usually that's done on an annual basis when looking at the budget of the overall company, and then the budget of the departments, and then it goes down to the department heads, and then the individuals in that department, each of them getting some sort of KPI that relates to that. You want to develop a KPI dashboard. I kind of call this the island report for the owners, where if you were stranded on a deserted island and you only had one report to see how your company is doing, what KPI would be on that report. So that's a report that you want to have in order, especially if you're an owner and you want to be able to have the freedom not to be so strapped to the company, especially as it becomes more successful. You need to have a strong KPI or dashboard for yourself, as well as for your other employees. So in this digital age, this is more and more, in my opinion, doable, and frankly, a must. 3 is combine financial and non financial indicators, they become even more powerful KPI because you're marrying different aspects of a company, not just financial, non-financial, give you even deeper insights. You want to use industry-specific KPI, not only the general KPI, which again is important, but the more industry-specific you have to layer it, that'd be a second or deeper tier of key performance indicators. They're real helpful. And we offer plenty of that when we work with a specific company. We give them the general KPI, then we drill down to their industry so that they can get a better feel for it, and then we compare it to themselves, and then they could see that dynamics, especially if your company is straddling different industries, offering maybe a service as well as selling a product. We might have to grab different KPI to customize it as it relates to your company, and that can be very, very useful. And then use KPI as a guide. Again, it's not the end all, and use it properly. I guess I would add to that as well. Make sure that the KPI is measuring the right performance. And you could always back test it where you're saying, you know what, if we applied this KPI 3 years ago when things were going really well, what would it look like? And how does it look now? And why is it different? So you can go back in history and see how well this KPI would have been as a leading indicator if you go back, and then that'll give you that much more comfortable as to how the tool reacts to the different things that might be happening in your company. And you want to use leading indicators as well as lagging indicators. Like I said, most companies use lagging indicators. 1 or 2 leading ones can be very helpful with driving your sales for your company. And again, just be careful if you're going to drive sales to a certain level because you've added these salespeople and you're armed with all these KPI. Just make sure that operationally, that the managers who have to handle and support that sales are in place as well, or else you're going to have a different set of problems with a lot of revenue and maybe a drop in performance on an operational level of delivering on those sales. So you want to make sure everything's in sync with that. And then lastly, use it as a great communication tool. This is the owners communicating to management, management communicating to the rank and file employees. So you're all on the same sheet of music and you're talking a lot of the same common language. And this will allow you to have frequent meetings with employees that maybe you were avoiding in the past. They could be frequent but short and very pointed meetings. They don't necessarily, in this day and age, have to be face-to-face. In that context. Right, and then just talking about CFO on demand, obviously we work with key performance indicators quite a bit. We help we help our clients who are working mostly with the financial reporting part of it, with their internal or external accounting departments, and doing this financial analysis. That's all about KPI and how we help support that. The accountants struggle with that because that's not an area they're really comfortable with. Business owners know they need it, but that only pulls them off the mark as far as the financial growth of the company. What we do here at CFO On Demand is that we reinforce this line through using key performance indicators so that the business owners can make better decisions, be more strategic in their decisions, not reactive here as just business operators. They're more as business strategists here, and then they can focus on the growth of the company, feeling comfortable that the financial analysis has been done and they can make the best decisions that they can, because we know that business strategists always beat our business operators. Here we're taking some Marvel characters here. I think that's Iron Man on the left, who's our business strategist, and the Hulk, who tends to be more reactive and just does it and then has to live with the consequences of their decisions. So you want to be more of a business strategist ongoing and less of a business operator, because a strategist beats the operator every single time. All right, we just have, let's see here, questions. We have one question. Let me just read it here. These are the upcoming webinars. And what we'll be doing is we're going to start adding for next year's series. So you'll see more next month. You'll see more coming in for January, February, and March. But our upcoming webinar will be the benefits of automating your business financial functions. We'll talk about the time and money saved with automating the process here. And the one question that we have relates to KPI and where to get started. The best place to get started with KPI is not to feel like it has to be perfect for every person there. You want to build on the KPI there. You could start with just a couple on a person sheet and then build from it. Don't feel like it has to be perfect before you roll it out. All right, that is the end of our time. Thank you very much for attending and look forward to seeing you next month.